Line up in red.
All right, good morning. The Subcommittee on Capital Markets will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled The Future of American Capital, Strengthening Public and Private Markets by Increasing Investor Access and Facilitating Capital Formation. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. Chairman, I now recognize myself as chairman for 4 minutes for an opening statement. Good morning, and welcome to our very first Capital Markets Subcommittee hearing. I want to thank you all for joining us today. We're going to be discussing ways to strengthen both public and private markets by expanding investment opportunities and reducing regulatory barriers to capital formation. Securing funding is essential for small businesses, yet many entrepreneurs face roadblocks. While the Bipartisan Jobs Act of 2012 was a landmark step in making capital more accessible, significant regulatory barriers remain. If we fail to act, we risk stifling innovation and economic expansion. One of the most pressing challenges is the restrictive definition of accredited investor. Current regulations primarily allow only high net worth individuals to invest in private markets, shutting out many financially knowledgeable Americans who have the expertise but perhaps not the wealth to participate in these opportunities. Expanding investment opportunities beyond the limited few who qualify under this narrow definition will unlock new sources of capital, benefiting both businesses and investors. Small businesses also face growing obstacles when seeking funding. Traditional bank loan approval rates have dropped significantly, leaving many entrepreneurs with limited options. No business should be forced to rely solely on financial institutions when alternative sources of capital are available. Expanding investor access to private markets and streamlining regulatory requirements for raising private capital will create more opportunities for businesses to secure funding and for investors to participate in economic growth. These challenges are not just theoretical. This is the reality faced by American entrepreneurs. My constituent, Andrew Barnell, who is here today, and his sister Erica are perfect examples of why access to capital matters. Their entrepreneurial journey demonstrates the power of an American innovation, but they, like too many founders, especially those in communities outside traditional financial hubs, have faced barriers that limit their ability to expand and create jobs. Across the country, countless small businesses and entrepreneurs face similar roadblocks, preventing great ideas from becoming successful job-creating enterprises. As Acting Secretary Chair Uida recently said, and I quote, "We should be encouraging, not restricting, the ability of companies to raise capital. Regulation should protect investors, but they should not suffocate market access or drive companies overseas. We must ensure both public and private markets remain viable. Funding options, giving businesses the flexibility to grow in the way that best suits them. The reforms that we discussed today build upon the foundation by the Jobs Act and by reducing regulatory barriers, increasing access to capital, and safely expanding investor access. We can ensure that innovation and economic growth continue to flourish. To ensure that we get this right, after today's hearing, the committee will be requesting feedback from stakeholders on legislative proposals aimed at strengthening our capital markets. And we want to hear directly from investors and entrepreneurs, small businesses, and all market participants about how we can improve access to capital without sacrificing investor protection. After this hearing, we'll put out a press release that's going to be requesting feedback via this press release and a list of prompts on the Financial Services Committee website. So go to Financial Services services.house.gov. Access to capital is not a partisan issue. It's about ensuring that businesses and investors and workers have the tools that they need to succeed. I want to thank you all. I look forward to today's discussion. The chair now recognizes the ranking member of the subcommittee, the gentleman from California, Mr. Sherman, for 4 minutes for an opening statement.
The SEC oversees our capital markets, which is the nerve center of global capitalism. Virtually all of the most powerful companies in America and really the world have functioned with one goal: increase the value of their company securities in our capital markets. Our capital markets are the envy of the world, and the securities traded there are worth over $100 trillion. So I don't think it's a good idea to let big balls just take a whack at it. Whether it's crime in the streets or crime in the suites, we should not defund the police. The SEC more than pays for itself. It's got a $2 billion budget. It secured over $8.2 billion in fines last year and returned $3.2 billion to investors. And one thing I'm concerned about is insider trading. We saw this when, for 1 week, everybody knew when Trump got elected, crypto would go up a bit. And Bitcoin went up 22% in that first week. But Dogecoin went up 135%. During that week, there were only a couple of people who knew that this commission would get this weird name designed to advertise one crypto coin. I don't know who knew that, but I do know that Elon Musk is more powerful than any one member of Congress. I'm humble enough to say that. But Musk does not file any of the financial reports that we have to file. We will see a couple years from now whether we see $8.2 billion a year returned by the new SEC in fines and a $3.2 billion to investors. If not, it will not be because there are no crooks on Wall Street. The wolves of Wall Street are not going to become lambs. It will be because the SEC was defanged and or defunded. Business needs capital, particularly small and medium-sized business. Traditionally, that was banks. But we've told all the banks they can't even make any prime plus 3, prime plus 4 loans. We need to focus on bank regulation. We need to allow credit unions to make more business loans. We need to allow the BDCs to play their role in developing businesses. That's why I've got the Access to Small Business Investor Capital Act, which I introduced in the 116th, 117th and 118th Congress. I will be reintroducing it in the 119th Congress and look for as many co-sponsors as possible. Finally, our banking system discriminates against business loans by saying that if the banks instead deploy their money into marketable securities, they don't have to mark-to-market their losses, particularly those securities they list as being ones they plan to hold to maturity. As to the accredited definition, investor definition, it needs work, but not just expansion, but also contraction. The idea that somebody is high income because they have $200,000, keep in mind, members of Congress, if they get reimbursed for their living expenses here in Washington, are listed as having incomes of $200,000, and not a single one of my colleagues has said that the congressional pay package represents high income. And $1 million does not make you wealthy in the current system. When we passed these laws, it was back in the 70s. Prices have gone up by a factor of 7.7. So we've seen an erosion of the definition of accredited investor when based on wealth to the tune of 7.7 times. We need to change those numbers on the one hand, and, as the chairwoman points out, also account for the fact that people who don't have high income, don't have high wealth, may have high knowledge and ought to be listed as accredited investors. And I yield back.
Gentleman yields back. The chair now recognizes the chairman of the full committee, the gentleman from Arkansas, Mr. Hill, for 1 minute.
I thank my friend and colleague, our chairman, Mrs. Wagner, for hosting today's hearing. Look forward to working alongside you, Chair Wagner, as we work to ensure America's capital markets remain the strongest and the most competitive in the world. Capital formation is the bedrock of our economic growth. It fuels innovation, empowers small business, and creates opportunities for everyday Americans to build a nest egg and wealth. Yet in recent years, we've seen an alarming trend. Fewer companies are entering the public markets, and when they do, they face skyrocketing regulatory burdens, stifling growth and job creation. At its peak, the Wilshire 5000 Index, a benchmark for the entire stock market of the United States, had 7,500 companies. Today, that number has been cut in half. If we don't act now, America's public markets will continue to shrink. Committee Republicans are committed to reversing this trend by building on our Jobs Act work, and I look forward to working with you, Madam Chair, and I yield back.
Gentleman yields back, and the chair now recognizes the ranking member of the full committee, the gentlelady from California, Ms. Waters, for 1 minute.
Thank you very much, Chair Wagner. Democrats have always championed small businesses. In the 117th Congress, we passed landmark laws, the Inflation Reduction Act, the CHIPS Act, and the American Rescue Plan that bolster small business and economic growth. We know that when markets are fair, disclosures are honest, financial intermediaries act in investors' best interests, and the Securities and Exchange Commission enforces the law, business confidence and investments flourish. But Trump and unelected co-president Elon Musk are looking to defang, defund, and defame Wall Street's cop on the block, the Securities and Exchange Commission. Fiddling with requirements in our securities laws seems to miss the mark when the arbiter of those laws is on the chopping block. I yield back.
The ranking member yields back. Today, we'd like to welcome the testimony of our 5 witnesses. First, we have Mr. Andrew Barnell. Mr. Barnell is the CEO and co-founder of Genoscopy, I guess that's how you pronounce it, yes. He is also one of my constituents, with whom I've had the pleasure of meeting many times, and from their office in St. Louis, Mr. Barnell's business has developed an innovative and life-saving colorectal cancer screening technologies. Next, Mr. McKeever Conwell. Mr. Conwell is the founder and managing partner of Rare Breed Ventures, an emerging VC fund located in Baltimore, Maryland. Next, we have Ms. Rebecca Kacaba. Ms. Kacaba is the CEO and co-founder of Dealmaker, the global leader in online capital raising. Next on deck is Ms. Anna Pinedo. Ms. Pinedo is a partner in Mayor Brown's New York office and co-leader of the Global Capital Markets practice. And last but not least is Ms. Alexandra Thornton. Ms. Thornton is the Senior Director of Financial Regulation for Inclusive Economy at the Center for American Progress. We thank each of you for taking the time to be here today. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony, and without objection, your written statements will be made part of the record. Mr. Barnell, I believe you also have your wife with you today. We welcome you. Ms. Barnell, you are now recognized, sir, for 5 minutes for your oral remarks.
Chairwoman Wagner, Ranking Member Sherman, members of the subcommittee, thank you for inviting me to testify today. As a native of St. Louis and the CEO of Genoscopy, a life sciences startup headquartered in St. Louis, I am especially proud to be here today before our member of Congress, Chairwoman Wagner. At Genoscopy, we are developing innovative diagnostic tests for gastrointestinal health. We are in the process of bringing our first product, ColaSense, to the U.S. market so more individuals can access life-saving screening options for colorectal cancer. I'm here today to share my experience with respect to raising capital for our company, a journey that began in 2015 when my sister called to inform me she developed a technology that could save countless lives and that we would be founding a company together to do just that. At the time, I was an MBA student at the Wharton School, and my sister was an MD PhD student at the Washington University School of Medicine in St. Louis. I jumped at the opportunity. It was a logical extension of my coursework in business and healthcare and my early professional career in the financial services industry. 10 years ago, we started as 2 students with an idea. We have since cultivated our business into a company with over 50 employees. We've raised over $150 million of venture capital and are poised to bring a novel solution to market to address the second deadliest, yet most preventable cancer in our country. Today, I have 3 topics to highlight: the importance of startups to our economy, the challenges that exist for startups when raising capital, and how good policy can help facilitate access to capital. Startups are critical economic growth drivers in the United States. In 2023, over 5 million businesses were started in the US alone. Small businesses defined as having fewer than 500 employees have accounted for 71% of total job creation in the current business cycle, and new startups alone account for 26% of total job creation. Serving for centuries as the global epicenter of innovation has made America's economy the strongest in the world. Looking forward, as we move into new phases of disruptive change, it is critical for our country to continue to support startups through a strong workforce, supportive infrastructure, good government policy, and a culture of entrepreneurship and risk-taking. Approximately 90% of startups fail. In one study of failed startups, the top reason cited for failure was running out of cash or failing to raise new capital. Startups need capital to cover the initial costs of launching and operating their business, supporting expenses such as product development, marketing, hiring, office space, inventory, and research. Fundraising is a constant challenge for founders. It is estimated that venture capitalists fund fewer than 1% of the pitches that they receive. At Genoscopy, we have navigated the full spectrum of capital raises: friends, family, angels, all the way through institutional venture capital, and we have seen all of these challenges firsthand. But we also count ourselves as fortunate, having the background to overcome being young, first-time entrepreneurs, raising capital outside of Silicon Valley. Given the importance of startups to our economy and the challenges that exist for startups in raising capital, it is critical that government policy facilitates and does not stifle access to capital. Our experience highlights the importance of the legislation under consideration by this subcommittee. Early-stage investors like to deploy capital locally, and areas such as the Midwest see significantly less capital and venture capital investment per capita than other areas such as the West Coast. Lessening the burden for angel investors, lowering the barriers for venture fund formation, and making crowdfunding more pervasive would all help startups access vital growth capital. Genoscopy will require additional capital to grow and is preparing to access the public markets. However, disclosure requirements and the regulatory burden can be daunting. Alleviating these barriers for emerging growth companies makes sense. Lastly, included here, appended to my written testimony, is a copy of written testimony that I submitted to your colleagues on the Ways and Means Committee last October, describing the valley of death that life sciences startups often face after FDA approval, but before Medicare coverage and inclusion in quality metrics. Beyond the topics of access to capital I've highlighted today, improved federal policies that streamline Medicare coverage and payment, and more nimble federal agencies that embrace innovation are the key ingredients that life sciences startups like Genoscopy require to cross the valley of death, and in turn, boost the economy, increase job growth, and save lives. I thank you all for your attention to these issues and for the important work you're doing on this subcommittee to ensure access to capital. Thank you again for the opportunity to provide testimony and for your consideration of my recommendations. I stand ready to serve as a resource to you and your colleagues and welcome any questions.
Thank you, Mr. Barnell. Now, Mr. Conwell, you are recognized for 5 minutes for your oral remarks.
Chairmanwoman Wagner, Ranking Member Sherman, members of the subcommittee, thank you for the opportunity to testify today on the importance of creating better access to capital for both entrepreneurs and those who fund their amazing companies. My name is McKeever Edward Conwell II, and I am the founder and managing partner of Rare Breed Ventures, which I am representing today. Rare Breed is a venture capital firm that invests in and supports innovative startups at the earliest stages. In 2020, I launched Rare Breed Ventures in a response to the lack of access to capital for founders of color and founders outside of major investment hubs like New York and California, as well as a response to the lack of cultural competency from many VCs when it comes to investing in founders who don't look like them and don't come from similar backgrounds. These two issues came to me in the form of one entrepreneur, a woman by the name of Shauna Step-Jones, a Black single mom from Baltimore who was creating a dryer for wigs. I immediately got what she was creating, but other investors didn't. So after 3 years of watching her get nothing but no's from folks who didn't look like her and didn't understand what she was trying to do, she decided the only way for her to get access to capital was to become a surrogate mother, even knowing that Black women are 3 times more likely to die from pregnancy-related causes. This is nothing to say about her 3 degrees and the fact that she was a former patent examiner, right? This is why I started Rare Breed, but I didn't have a network of wealthy folks to raise from. That forced me to get creative and use 2 regulations to help. First was Rule 506C of Regulation D, which allows for public solicitation of fund offerings, but requires that every investor in that fund be an accredited investor. The second was an amendment to Section 3C1 of the Investment Company Act of 1940, which allowed for a fund of $10 million or less to raise from up to 250 investors instead of only 100. The first regulation allowed me to use social media, Twitter mainly, to meet with many potential investors. Thanks to this, I was able to have 1,128 meetings in my first 90 days and more than 4,000 meetings in total. The second regulation allowed me to offer investors to invest as little as $10,000 compared to the traditional $100,000 they would have had to put up before the amendment. This led to me having 194 investors in Rare Breed. Of those investors, 83.5% invested $50,000 or less. Many of these investors were people of color and first-time investors and funds because they hadn't had access to make such an investment and couldn't risk the high minimum threshold for a fund. This means that before they were limited to investing in companies either directly, where there is a much higher risk of losing all of their money, or investing in stocks of publicly traded companies, which the average venture fund has historically outperformed according to Harvard Business Review. But unfortunately, without something like the ICANN Act, almost all of those small dollar investors who make up 83.5% of my investors will not be able to invest in Rare Breed Ventures Fund 2. That's 162 out of 194 investors, since our new minimum will have to be 250,000 plus. The current rules limit the amount of capital and sources of capital for smaller and newer investment funds, leading to less capital to help drive innovation, economic growth, and job creation, especially when talking about companies started by founders of color, because we know that in particular, Black-led funds are 4 times more likely to invest in Black-led companies. Also keeping in mind that almost all of the Black-led venture funds in America would fit under the new rules under the ICANN Act because most of our funds are under $150 million. With the ICANN Act, such limiting factors would be greatly reduced, allowing more accredited investors to have the opportunity to participate in this asset class. With lower minimums, investors can potentially invest smaller amounts of money into more venture funds to spread out their risk and better diversify their investments. Today, many funds have to turn away investors because of these current limits. This results in millions of dollars, if not billions, in potential funding for future innovation and job creation, while also excluding investors from being able to truly diversify their own investments and limiting the ability in wealth creation. Even more so, those who do have enough wealth to continue to participate in the venture asset class are almost exclusively from a non-diverse population. This only serves to further widen the racial and gender wealth gap in America and puts limits on the type of innovations we see in this country. I am excited to see Congress working through issues that impact the access to capital that drives innovation. As someone who spent my entire career in venture capital as an advocate for access to capital and reducing barriers, I look forward to being supportive and assisting this committee in any way possible. Thank you for the opportunity to testify today. I look forward to any of your questions.
We thank you, Mr. Conwell. Next, we'll hear from Ms. Kacaba. You are recognized for 5 minutes for your oral remarks.
Chairwoman Wagner, Ranking Member Sherman, and members of the subcommittee, thank you for the opportunity to testify before you today. My name is Rebecca Kacaba. I am CEO and co-founder of Dealmaker, the leading platform in online capital formation. To date, Dealmaker has facilitated over $2 billion in capital raised for over 900 American companies, creating up to 40,000 new jobs. I come from a family of entrepreneurs and am a former practicing attorney, having spent over a decade in private practice in the capital markets. The team at Dealmaker have the distinct honor of working with founders building businesses they love. We see firsthand the difficulties of the entrepreneur's journey and how much they and their families sacrifice to grow a business and create jobs in America. We know the founder who slept on the storeroom floor for a year until he could get his business funded. We know the founders who stake their personal relationships and reputations, raising money from friends, family, and colleagues in order to get the idea they believe in off the ground. The very hope, vision, and purpose of our founders is why we do what we do. This is the essence of the American dream and what drives job creation. Every day, our team is privileged to serve these founders in the most fundamental way possible, and we take this responsibility seriously. We do this by implementing Congress's pioneering vision of the Jobs Act itself. In the spirit of this vision, we submit 3 proposals designed to ignite economic growth and create new American jobs. The first proposal is to remove the offering caps that inhibit growth and interfere with job creation. Reg A is capped at $75 million. At Dealmaker, we regularly see companies who could raise more than $75 million. We ask Congress to remove the offering cap altogether. In the modern internet era, a cap on Reg A officially constrains growth. Because of the cap, companies are using alternative structures like donations, tokens, or institutional funding. Removing the Reg A maximum creates a pathway to bringing unregulated capital formation activities into a regulated space. To grow the space, we need to change the perception that only small companies can use the exemption. Reg CF is currently capped at $5 million, which should be increased to $10 million. The 2020 increase in the Reg CF cap from 1.25 to 5 million stimulated market activity by 250%. The Reg CF ecosystem is maturing with a growing prevalence of broker-dealer participation as opposed to just funding portals. Companies are regularly reaching the $5 million cap on Reg CF offerings. When companies hit this maximum, they face 2 suboptimal choices: either return to traditional funding sources or prematurely transition to a more costly Reg A. Our second proposal is to harmonize the Reg CF and Reg A regimes. Today, Reg CF and Reg A exemptions are being used for similar purposes. Investors are investing in both types of offerings interchangeably. Accordingly, the rules between the two should be harmonized. The best elements of each regime can be combined and shared. This would be easier for businesses, investors, and market participants to understand and lead to better compliance. 3 places where harmonization would remove significant friction are Rule 12G, Rule 5110, and the marketing rules. We have cited a number of the bills tabled where these harmonizations can be addressed. Finally, the third proposal is to expand the availability of Reg CF and Reg A to more participants to grow the space and create more jobs. Currently, Reg CF restricts the amount of money companies under common control can raise. This restriction differentiates Reg CF from traditional capital raising mechanisms and Reg A, which do not have such limitations. If the common control prohibitions are removed, it would allow more VC-backed companies to enter the space. This would capitalize more mature-funded businesses and could also increase the survival rate of venture-backed businesses. In conclusion, let's reflect on how far we've come. Since Congress enacted the Jobs Act in 2012, Reg A and Reg CF have raised $3.7 billion. Reg CF has outpaced venture capital growth by 4.4x as compared to 1.3x. The capital markets have been diversified as Congress intended to weather economic down market conditions. During the worst year of the recent down market cycle in 2023, the online capital markets stayed over 40% stronger than the VC markets. Companies we supported survived and thrived when no one thought it would be possible. By increasing the offering limits, harmonizing the rules, and allowing for more capital markets participation in the space, Congress will unlock even more growth in online capital markets, leading to further job creation. The work that Congress is doing is critical and core to the job creation ethos of America. As a result of your work, we have the privilege of seeing firsthand our customers' factories in new communities that are overlooked by Silicon Valley and Wall Street, and the pride that it brings them. We are grateful for the opportunity to be a part of this hearing.
Thank you, Ms. Kacaba. Next on deck is Ms. Pinedo. You're recognized for 5 minutes for your oral remarks.
Chairman Wagner, Ranking Member Sherman, and subcommittee members, thank you for inviting me. I appreciate this opportunity. I have been a securities lawyer for over 30 years, and I'm a partner at Mayer Brown. My comments today reflect my own views. I began practicing in the early 1990s when IPOs, including IPOs by smaller companies, were quite plentiful. That gave me the opportunity to work on many IPOs for companies of all sizes. It was a time when the financing trajectory for companies was quite well understood and predictable. Within 5 to 7 years of inception, a company generally sought a liquidity event, and usually that liquidity event was an IPO. Historically, an IPO allowed a company to raise a significant amount of capital, more capital than it could raise through any other means. An IPO was also regarded as an achievement for founders and for the company's investors. During that period of time, there was also an infrastructure that supported these companies. Over time, the market has evolved, as we've discussed. Exempt offerings have become more significant with increased use of shelf registration statements, promulgation of various safe harbors, shortening of the Rule 144 holding period. At the same time, there's been a proliferation of additional investors in the private markets, hedge funds, private credit funds, private equity funds, and other investors. The shift away from IPOs in the public markets has occurred as a result of market structure changes and an increased regulation with Sarbanes-Oxley and the Dodd-Frank Act and the costs associated with being a public company. In recent years, more prescriptive disclosure requirements have arisen that add to this list. More recently adopted disclosure requirements have moved away from the bedrock principles of our securities framework, that of materiality. So what's the upshot of all of this? We have fewer public companies now than in the 1990s. The overall number of IPOs has declined based on historic levels. Smaller public companies are disproportionately impacted by the costs of being public. Once they are public, they benefit less from their publicness. What do I mean by this? I mean that once a company becomes public, historically, it was always the case that it should be easier for these companies to raise money in the secondary market, that they would have liquid stock, that there would be research analyst coverage for them. But the historic promise of being public is not being realized for our smaller and medium-sized companies. They're bearing the costs of being public, but they're not reaping the benefits. We should fix this. Reliance on funding in the private markets has outpaced reliance on registered offerings. Regulators and legislators have expressed concerns regarding the growth of the private markets and their opaque character. As I noted when I previously appeared before this subcommittee, it would be a really grave mistake to look at the private markets as being suspect and in need of regulation, and as the public markets, by contrast, as being transparent and as being the best and the only solution for most companies. Regulating the private markets out of existence is not going to magically bring back institutional investors who are going to support microcap and small cap stocks, nor is it going to magically bring back equity research coverage for small and microcap stocks that would be forced to become SEC reporting companies before they're ready to do that. It's important to recognize the markets have changed in really significant and irreversible ways, and not to respond with reactionary responses. Most private investments are limited to accredited investors. Only 19% of US households qualify as accredited investors. However, in practice, I can tell you that most investments are limited to institutions and not to accredited investors. Most of the bills under consideration today would fix this. In addition, they would strike the right balance and reach a new equilibrium between private and public and address other changes, including providing access to a broader group of individuals through potentially registered funds, and provide greater access to capital formation for BDCs and other registered funds that address capital formation. In my testimony, I suggest a number of other recommendations for consideration. So I thank you for your attention.
Thank you, Ms. Pinedo. And Ms. Thornton, you are now recognized for 5 minutes for your oral remarks.
Thank you, Chairman Wagner, Ranking Member Sherman, and members of the subcommittee. Thank you for the opportunity to testify today. Capital markets work best when there's an informed bargain between the seller and the buyer of securities. Investors seeking returns provide their capital to businesses and funds, who in turn put that capital to use. Information is an essential part of that bargain. Without it, there would be significant investor loss and economic waste. U.S. capital markets are the most robust in the world, in large part because they require those seeking to raise capital from investors to provide basic information to investors. The government doesn't block investors, it doesn't approve or disapprove of investments. Congress decided long ago that investors needed the government to ensure they had fundamental, accurate information and basic rights, and with those tools, investors would be empowered to drive our capital markets and economy forward. The disclosure of information improves price discovery, makes the markets more fair, more orderly, and more efficient, and protects investors from abuses, such as information asymmetry. Even the most sophisticated investors cannot exercise their superior knowledge and expertise if they don't have reliable information about a company's financials, operations, and risks. Many of the bills before the committee today, however, would expand the ability of private market companies and funds to sell securities to a broader range of investors without providing accurate information about operations, management, risks, and financial position, the amount and type of information that potential investors and other participants in the public markets receive. This is not expanding or improving capital formation, it is increasing risks for more investors and tilting the bargain in favor of the private party seeking capital. It is expanding the reach of those hidden risks into potentially millions of American homes. The timing for much of these proposals seems particularly ill-advised. Private markets are becoming ever larger. Without mandated information, asset prices frequently become detached from the underlying intrinsic values of the assets themselves, especially among large, highly valued private firms or unicorns. Private company and private fund stakes are frequently being sold in loosely regulated secondary markets at fractions on the dollar. And different groups of investors are frequently treated differently and provided with different information or none at all. And while there is strong evidence that fraud occurs, it's difficult to police. Introducing to these markets non-professional investors who don't have dedicated accountants, lawyers, risk officers, or investment professionals, or billions of dollars that they can afford to leave locked up for 10 years at a time is extremely risky and will likely lead to extensive losses for those investors and waste of capital. It could facilitate the ability of private companies, funds, and their founders and early investors to offload their riskiest, worst opportunities onto a less discerning customer. That's not improving or forming capital, it is simply enabling a wealth transfer away from the retail investors who lack information. Worse, the Securities and Exchange Commission, which ensures this essential bargain between companies, funds, and investors, is facing significant changes right now that could hamper its ability to protect investors. When the securities laws were first adopted and in the decades thereafter, offerings to even a single person or to a small number of employees were deemed to be public offerings in need of being registered. But beginning in 1982 with the promulgation of Regulation D, there's been a proliferation of exemptions from the public disclosure framework. The stated intention of those exemptions and their subsequent expansions has been to provide more access to capital for small businesses, but the reality is that those exemptions, along with a couple of loopholes in the law, have enabled virtually any company of any size to obtain capital from the public without complying with the public disclosure framework. As a result, a substantial and growing number of companies are choosing to remain private as they raise capital and often only end up coming to the public markets to cash out significant investors and founders. The result of Congress and the SEC creating and expanding exemptions from the federal regulatory disclosure framework is that the vast majority of capital raised is exempt, and that explosive growth of the private markets has come at the expense of public markets. The problem is not that the rules prevent small businesses or startups from obtaining capital. It is that the rules allow companies with billion-dollar valuations, billions in revenues, and thousands of investors to never provide basic information to investors, regulators, and the public, and private funds to raise billions of dollars from underlying investors without basic expectations like timely, comprehensive, and reliable disclosures about their finances, governance, and operations. The situation enables capital distortion, like inflated valuations, lax internal controls, inconsistent disclosures across investors, and potential fraud and abuse. And today there are more than 1,200 private companies with more than $1 billion each. In my written testimony, I've included several recommendations for how to rebalance public and private markets, and I want to thank you for inviting me to testify today. I look forward to answering questions.
I thank you, Ms. Thornton, for your testimony. We'll now turn to member questions. I recognize myself for 5 minutes for questioning. Mr. Barnell, access to venture capital funding is not evenly distributed, with most funding concentrated in California, Massachusetts, and New York. Entrepreneurs in other parts of the country, such as St. Louis, where you and I come from, face greater difficulties in raising the capital necessary for scaling. Can you discuss some of the difficulties you faced early on in raising capital?
Absolutely. We faced no shortage of challenges. We were two students, first-time entrepreneurs raising capital in an industry that's highly regulated and technical. I would say hands down the biggest challenge we had early on was that in St. Louis, there are only a handful of early-stage venture firms. And raising those first couple rounds is always the most challenging. And so raising that capital was definitely the biggest challenge.
Have you ever met with VCs in California, for instance, and what was your experience trying to gain investor interest in your company?
Extensively. So we spent a lot of time, even early on, going to the coast. And one of the things that we found, particularly for early stage investment, angel, seed, is that investors like to invest in their own backyard. I remember an angel investor who ran a fund out in San Francisco telling me, we love what you're doing, we love the technology you've built, but why would we invest in you when I can invest in 25 companies just like you in San Francisco?
Mr. Barnell, can you discuss how the policies discussed today and the bills that we're putting forward, some 36 of them, can improve access to capital for startups in areas like St. Louis?
One of the other things I wanted to highlight from my experience, and I'll focus on our early rounds as well, there is no shortage of people that want to invest in innovation, want to invest in companies like ours, the next big growth companies in the country. But I can say, coming from St. Louis versus traditional VC hubs, we don't have as many of those systems and infrastructures to do it. There aren't as many demo days and incubators and angel funds for people to join and participate in. So as I mentioned in my written testimony, things such as making it easier for venture funds to form, making it easier to make venture investments, crowdfunding, being thoughtful about the accredited investor definition, all of those things really would help companies like ours.
Thank you, Mr. Barnell. Ms. Pinedo, retail investor access to pooled investment vehicles that invest in our private markets seems to be overly restrictive, whether it be through closed-end funds or other types of funds. Do you believe that such restrictions on retail access are justified?
I agree. The retail access is overly restrictive, in particular into interval funds, closed-end funds, and other funds. And to address some of the concerns that Ms. Thornton alluded to, it would be prudent to look at modernizing the regulation of funds and fund access for retail investors. That's included in my testimony, including specific recommendations along those lines. It would be a way to allow access to other investors in a very controlled way within the framework provided by the Investment Company Act and with information requirements, so it would address many of the concerns that Ms. Thornton recommended. Currently, for example, many funds can only be sold to qualified clients. Many funds are limited in their ability to invest in private funds or in private securities. A number of the bills under consideration address the restriction.
That, correct. Now, let me ask you, would removing the limitations on closed-end fund investments in private securities help address this issue?
It would address, in part, the issue of directing more, of increasing or promoting capital formation.
Is there anything in the closed-end fund proposal discussed today that would remove investor protections?
Not one thing.
And why are private markets significant to capital formation, and why should we pursue policies that make private market an attractive place to raise capital? And do such reforms have to come at the expense of making our public markets more attractive?
We shouldn't see it as a zero-sum game. It would be entirely wrong for us to see these as in conflict with one another. The SEC's Office of Advocate for Small Business, which takes into account and has as its goal investor protection, makes it quite clear that the private markets should not be seen as competing with the public markets. We need vibrant private markets.
Thank you, Ms. Pinedo. The chair now recognizes the ranking member of the subcommittee, Mr. Sherman, for 5 minutes for questions.
As our first witness pointed out, 90% of these startups fail, but it is a national interest to see them funded because the 10% that succeed can revolutionize our society. That's why we need to make sure that these companies are able to get bank loans, that BDCs are able to invest, and that individual investors can invest. But we want to protect the individual investors. Republicans have often said that there's been a decline in the number of public companies, and therefore there shouldn't be, and that's because we put too many burdens on public companies. If you want to register securities, it's not that easy. But another reason why there are fewer public companies is that we've made it easier to stay private. And nothing is a greater example of that than the definition of accredited investor, which in effect has been over 90% repealed. Well, you might ask, well, the statute's the same. Yes, the statute says $1 million makes you wealthy because it was passed in the 70s. That today would be $7.7 million. So we have by inaction, I think any statute that we pass that doesn't have an inflation adjustment in it is a mistake. And this one is a big mistake. It hasn't been adjusted for a long time. So we have made it much, much easier to be an accredited investor on the wealth and income standard, assuming that's even the right standard. Ms. Thornton, we have another rule, and that is a company becomes public if it has 2,000 beneficial owners. But we got a giant loophole. First of all, we allowed the SEC to take that from 500 to 2,000. Arguably, it should be taken back. But when we count beneficial owners, if there are 5,000 customers of Merrill Lynch who all have chosen to invest in a single security, those 5,000 people, how many do they count as under this rule?
Probably one.
One. That is new math taken to a whole new level. If we're going to have a limit on beneficial owners, and I think we should, we have to see through the street name. And it is convenient to hold the security in street name. You may, but we can count the beneficial owners. As to accredited investors, a lot of our discussion here is on how to reform that. We have now a standard based on wealth and income, and really, we set those standards in the 70s, so they're crazy. But wealth and income, even why are those relevant? They either connote knowledge on the theory that rich people know a lot about money, sometimes, or ability to absorb the loss. I would say that we ought to devise standards that are focused on knowledge, MBA, CPA, maybe attorneys, or the advisory team that it must be truly independent, and focus on ability to absorb a loss. Because our current rule makes you an accredited investor to invest 5 or 10% of your money in one of these startups, or 120% of your net worth in one of these startups. We value your wealth based on how much money you have, independent of your home, but then we say you can put a mortgage on your home, now that you're an accredited investor, to invest in a company with a 90% likelihood of failure. So I look forward to working with a definition of accredited investor that focuses on limiting the percentage of one's net worth or income that you're investing in any one issuance, limiting what you put into all private companies, and focusing on knowledge of the investor or their truly independent advisory group or advisors. But to have wealth or income, the idea that somebody has an income of $200,000 and therefore is highly knowledgeable and expert. Again, my colleagues have incomes of $200,000 just for working in Congress, and only some of them are geniuses. So I look forward to working on that, and I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Arkansas, Mr. Hill, who is also the chair of our full Committee on Financial Services, for 5 minutes.
Thank you, Chairwoman. Again, thanks to the panel for great testimony. We appreciate you being with us today. Ms. Scoba, I wanted to talk about the SEC's estimates on the cost of being a public company. These are the same numbers that I have in my notes from 2015, so they don't seem very updated to me. They say that to go public, a traditional IPO has upfront costs of about $2.5 million and annual compliance costs of $1.5 million thereafter. I was the interim chair of a small cap public company before I came to Congress, probably 10 or 13, 14 years ago, and our quarterly bill from just the accounting firm was $400,000 a quarter. So those numbers seem super out of date to me. Do you think they're accurate?
If it's okay, I will volunteer and answer that.
Yeah, well, I directed it to you. So
Oh, I'm Anna Pinedo.
okay, okay.
Yeah.
I can't see your name from over here.
That's quite all right. So you're absolutely correct that those are quite low. The average cost of going public for a company these days is more in the line of, just for is probably more around $4 million without counting the underwriter's spread, which is usually 7% of the amount that's offered, and then the cost of being public. In the SEC's Office of Advocate for Small Business, the costs are estimated in the study that the SEC put out in December of 2024, and the costs are significantly higher, just as you've just as you've recounted. And what's even more significant and more troubling, as noted in the SEC's advocate study, is that the costs are disproportionately borne by smaller and medium-sized businesses, particularly the costs associated with
Right.
SOX compliance.
Yeah, this has just been a 25-year, race to the bottom for encouraging companies to be public in this country. And we can do that in a safe and sound way, but the company that I served as an interim chair of so many years ago, just couldn't possibly do this. It had a market cap at the time of like $75 to $100 million. And, they were spending $6 million. Their profitability was probably $6 to $10 million in earnings before interest and tax, and they're spending what I just said, $2 million of that, a third, on being public. So it was a preposterous idea, and they went private, as you can imagine. And we don't have 5,000 companies in the Wilshire 5,000 anymore. We have 3,700. So we don't even have enough qualifying public companies to be in the Wilshire 5,000 index. We only have 3,700, and that is because these costs are out of control, in addition to the benefits of being private. If people want to be private, those costs have come down. The compliance burden is better. You can get to be a much larger cap company with private financing, no problem. But for people who want to access the public markets, we have built a wall that is ridiculous. Let's say we want these costs you're talking about to be 1% of total expenses. You'd have to be making, by my calculation, $500 million before tax to warrant being public. Well, that's ridiculous. We're choking off the golden goose that lays the golden egg for pension funds, labor pension funds, IRA accounts, 401k accounts. So I hope, Madam Chair, that we can do something about this ongoing cost and work with the Securities and Exchange Commission and those commissioners to bring it down to give more opportunities to our businesses seeking liquidity that way. Let's talk about accredited investors briefly. You think my idea of people that have professional qualifications in their area of expertise merit them being considered a accredited investor?
Consistent with some of the changes that the SEC made in 2020 of adding professional qualifications, yes. And this goes to what Mr. Sherman was saying of financial sophistication.
Right.
Financial sophistication has always been at the root of the definition.
Thank you very much for that. And Madam Chair, my time's expired. Yield back.
Gentleman yields back. Yes, and we have a number of bills that we hope are going to help increase access to our public markets. America has fallen behind. The chair now recognizes the gentlewoman from California, Mrs. Waters, who is also the ranking member of the full committee, for 5 minutes.
Madam Chair, thank you so very much. While a lot of time is being spent on what is or what is not happening with the SEC, I am reminded that Democrats have really been in the forefront of providing access to capital and support of small businesses. Democrats have a long history of promoting capital formation, both for small businesses and for communities that have been historically shut out of our capital markets and banking system. Now, if you will recall, during the pandemic, and after it became clear that the Paycheck Protection Program, or PPP, was only serving mega banks and concierge clients, when we put that money together, and some of the biggest corporations, et cetera, went after the money, and we were able to put more money into it. Nydia Velasquez and I put another, I think it was about $60 billion into the small businesses, the community banks, et cetera, et cetera. And what I realized during PPP was how good it is for us to be able to make capital available to small businesses. And when I travel around the country and I ask the small business people how many participated, their hands go up. because they remember, and it saved their businesses. It helped them to keep their personnel, et cetera, et cetera. Additionally, in December 2020, I worked with Secretary Mnuchin, who happened to be a Republican, and Democratic colleagues to secure $12 billion in capital investments and grants for CDFIs. Now, CDFIs are very important. Community Development Financial Institutions. We have worked very hard, and I want to know whether or not the opposite side of the aisle are going to support us as we go for increases for CDFIs so that we can have more money for small businesses. It really has done a great job in helping them to have access to capital. And I want you to know that the CDFIs and these minority depository institutions could be leveraged up to $120 billion in new financing for small businesses. In the American Rescue Plan, I led the effort to provide $10 billion to the state small business credit initiative to support tens of billions of dollars in new loans, investments, and technical assistance to support small businesses. So we have several pieces of legislation, like my bill entitled Promoting and Advancing Communities of Color through Inclusive Lending Act, to authorize $4 billion in additional support for CDFIs and minority depository institutions. So we've done a heck of a lot for small businesses. It's time to stop talking about we've got to do more. The only thing we can do is get rid of regulations that protect people. The SEC is our cop on the block, and they protect these investors. It's time to talk about what we're all willing to do to make sure we have access to capital. We have avenues by which we can appropriate money into in order to do what we talk about we want to do. And I'm going to have a whole package of bills, more bills, on how we can support access to capital for small businesses. And I want some support from the opposite side of the aisle, okay? I'm sorry I didn't have any questions for you. We've been talking about this for years, and so I'm trying to, help everybody to understand it's time to act. Capital formation should be at the top of our agenda. I yield back.
I thank the gentlelady. She yields back, and I thank her for her passion and fervor on this issue. It is. Capital formation is the basis of who we are in terms of the American economic system and capitalism. So we passed 36 capital formation bills across the House floor last year, many in a bipartisan way, and we hope to get Senate support this time around. I now recognize a gentleman from Oklahoma, Mr. Lucas, who is also the chair of the Task Force on Monetary Policy, Treasury Market Resilience, and Economic Prosperity. You're recognized for 5 minutes, sir.
Madam Chair, before I begin, I'd like to submit for the record a letter of support from MetLife on my bill with Mr. Gottheimer, Mr. Foster, and Mr. Barr, the Retirement Fairness for Charities and Educational Institutions Act.
Without objection.
Thank you, Madam Chair. And thank you to our witnesses for testifying today. The United States has the most robust capital markets in the world. Businesses, investors, the whole economy benefit when private and public markets are strong, resilient, and attractive. I think we all agree on that. Mr. Barnell, could you continue to talk for a moment about why we should focus on improving access to markets, particularly in capital-intensive industries? I'm from Oklahoma, so agriculture and energy are near and dear to my heart, but they are incredibly capital-intensive.
Absolutely. So speaking to our experience, there, and speaking to St. Louis in particular, there are so many great ideas coming out of academic institutions, but capital is needed early on. We hear a lot about minimum viable products and beta testing in capital-intensive industries. You need capital to prove out the concept before you can take the next step. And so ensuring we have policy that does that is critical.
During the previous administration, the SEC pursued an aggressive rulemaking agenda. The breadth and depth of those rules were simply unprecedented. And we've never seen anything like it. I've made the point that the former chair seemed to value speed and scope over quality during his tenure. In my view, the SEC should prioritize robust public engagement so we can trust that rulemakings are bolstering our markets, not stifling them. Ms. Pinedo, how can this administration differ in its regulatory approach to strengthen both public and private markets? Please.
We've already seen a very different tone from the acting chair of the SEC, and he has articulated in a speech just yesterday that the SEC intends to engage the public and solicit comments from the public and intends to prioritize capital formation, which is very welcome, and intends to solicit comment from the public on rulemakings, again, returning to the SEC's historic tradition. In terms of the bills that are before the subcommittee today, I think that they strike an appropriate tone in considering the realities of the private markets and acknowledging that we're not going to roll back time, and we need to really do what we can to foster robust private markets while doing so in a way that acknowledges the importance of investor protection. So whether that's promoting changes to the accredited investor definition that recognize that there are additional financially sophisticated parties that can be accredited investors. For example, if they're chaperoned by registered broker-dealers, by registered investment advisors, if they're advised by others in making those decisions, if they pass a test that's administered by the SEC or by FINRA, those are good qualifications and are wholly consistent with the mission of identifying investors that can fend for themselves. Those are not loopholes. So those are good, viable ways to qualify somebody as an accredited investor. Likewise, a lot of the changes that are considered in the bills today that would modify, for example, the rules relating to business development companies, that would reverse the SEC's policy from 2006 relating to acquired fund fees, that would bring more investors into business development companies. That's an important change. It would bring more capital and more investors into BDCs, and that would promote capital formation. We spoke a little bit about closed-end funds previously when Chair Wagner asked about it. That would allow closed-end funds to be sold to investors that aren't accredited investors. Again, an important change that would be beneficial yet protective of investors because closed-end funds are regulated under the 40 Act and under the 33 Act. So all of those things are very positive.
Thank you for those insights, and it's important we listen to stakeholders once in a while, isn't it, Chairman?
Hear,
Yield
hear,
back.
hear, hear. And we're going to have a great opportunity. Financialservices.house.gov, right following this hearing, so everyone, all stakeholders can give their 2 cents. The chair now recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you, Madam Chairman. Now, Ms. Thornton, the equity market has been transformed by an explosive growth in the private equity space. And 25 years ago, just think, we had 7,000 listed public companies in the United States and less than 1,000 companies owned by private equity investors. Today, more than 10,000 are owned by private equity investors, and just 4,000 are now publicly listed. How do you account for this?
Well, basically, it's because the rules have been changed since around 1982, as I said in my testimony, and expanded to the exemptions to the public disclosure framework and the need for companies to be public companies and comply with that framework. We also have an erosion of the 12G limit on companies' size when they can be in the private market. So now companies that are, whose shares are held by an institutional manager of some sort can basically count as one share. And so when you have that 2,000 shareholder limit, it's kind of meaningless when you have that situation and you have huge companies in the private markets. So now basically companies can grow huge in the private markets. We have, 1,200, as I said, worldwide in the private markets. Over 600 of those are US-based companies. Many of them are multi-billion-dollar companies, and they aren't mandated to disclose information, which is, I hear comments about how much disclosure has to be made when you go public, but the reality is that when companies do fill out all that IPO information, then for the first time in perhaps years, disclose their financials, and those financials are audited by an independent auditor, of course, information comes out about the true value of the company. And so I think it's incumbent upon us to insist that, for new investors especially, that information be disclosed. It's critically important when a company hasn't been disclosing for many years.
Well, thank you. And now we are always concerned about the two anchors that weigh here: interest rates on one hand, inflation on the other. How do you see that having an impact, those two?
I'm not really sure about that, but I think that as long as we make the rules such that people have a lot of options for raising money, then they should be able to do so. And we may need to provide more opportunities for small businesses, for example, to actually get loans and to have more funding through CDFIs or whatever. But we also need to make sure that public companies, all companies, disclose what the impact of those changes in interest rates and changes in inflation have on their company, on their financials. And so it's critically important, for example, that we have the Public Company Accounting Oversight Board, which is, make sure that the auditors who audit financials of public companies actually are doing everything right. So I think that's maybe how it's connected. I've kind of danced around it here, but I think that's really how it's connected, and we need to keep all that structure in place to make sure that investors have information about the impacts of these market factors.
Yeah, you're absolutely right, because right now these are the two parameters we're dealing with.
Yeah.
Interest rates and inflation. And our administration is dealing with this. We're dealing with it. We're moving to downsize the federal government. We're doing things right now that have never been done in restructuring it. And we got to be careful, and I'd like your points on what we've got to do. Thank you very much.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Sessions, for 5 minutes.
Madam Chairman, thank you very much. This is the most interesting hearing on not just capital formation, but the development of small business, IPOs, and all the things that lend themselves to America's future. Madam Chairman, I'd like to ask unanimous consent to enter into the record a letter from Mr. Teague Egan, founder and CEO of Energy Explorations Technology, known as Energy X, where he talks about the future of American capital, strengthening public and private markets by increasing investor access and facilitating capital formation. I ask that please be entered in the record.
Without objection.
Madam Chairman, we heard from Andrew Barnell, who is from St. Louis, Missouri, where I used to live. Know St. Louis pretty well. And he spoke about not just about the need for IPOs and new economic drivers for small business, but talked in his testimony to us about maybe being isolated in a market that was not as robust for raising money. So I would like to go, if I can, to Mrs. Pinedo and talk with her about, and I read in her bio about how she brings a lot of money from overseas to America, foreign financing that's here. I'd like to drill down on some of this because you talked about a balance that was necessary between private and public registered funds. But specifically, I'd like to talk about the role of engaging finders within the broker-dealer community, and we do legislation here. And if you have any ideas about exempting finders from registration, maybe in certain areas, but adding to this marketplace in cities that may be out of large investor areas. I'd like to ask you to please help us along that thinking, please.
The SEC has considered, and various advisory committees to the SEC have considered a finder's exemption and have suggested a framework for an exemption for finders for a number of years now. And the Small Business Forum that the SEC hosts every year has suggested and recommended that the SEC adopt a framework for finders. I think that a limited framework for finders from the exemption for registration from broker-dealers would be something that would be advisable. However, it should be a limited framework in light of the fact that we do have a need both at the state level and at the federal level to register persons who are providing services that are broker-dealer related. So I would look to the language that the Securities and Exchange Commission has considered previously in terms of the finder's exemption and the language that the advisory committees to the SEC have previously considered in terms of what would be appropriate by way of a finder's exemption. Along those lines, I would also consider adopting, finally, you brought up the topic of foreign activity, I would consider adopting or encouraging the SEC to undertake a study regarding adopting the amendments to 15A6, which are exemptions for foreign, for certain the activities by foreign broker-dealers for limited activities in the United States. These were amendments that were proposed by the SEC. They were well received generally by practitioners and by others, and they languished. And they relate largely to the activities of foreign broker-dealers with major institutional investors.
This is all, I think, good news, at least to me, because we found that there are people that want to over-regulate not only broker-dealers, they want to come in with other areas of government and hold people necessarily accountable about factors that were beyond their control, perhaps inflation, perhaps interest rate changes. So I think it's very important. I want to thank each of you for being here today. And I think, Madam Chairman, that gives us lots of room to work within a well-regarded idea. And I want to thank you for holding this hearing today. And I yield back my time.
Thank you. The gentleman yields back, and the chair now recognizes the gentleman from California, Mr. Vargas, for 5 minutes.
Thank you very much, Madam Chair, and I appreciate very much this hearing today, and I thank the ranking member also. Most of us are interested in protecting investors without sacrificing opportunities to generate wealth, and I think that's what we've been talking about today. But I do think that the cost of disclosure has been mentioned many times here. you have to place that against versus, the information that you need, the accurate information to protect investors. And that's one of the issues I want to talk about. The second one is, and I don't want to put words in anyone's mouth, but I did hear someone say that there really is no conflict between the private and the public market. I'm not sure that that's true. Or if it is, I'd like to see it, because it does seem that one benefits off the other a little bit. And then lastly, about the accredited investor, because I do agree with Mr. Sherman that it's not only wealth or assets, it's also knowledge, although I would almost challenge him to tell us which one of our colleagues is not a genius. In fact, I would give him a few seconds here if he wants to name names. But anyway, let's start with the cost of disclosure. Ms. Thornton, I mean, you heard it here, and I think it is true. I mean, if you have a company that's making $6 million a year and $2 million of it has to go for all these disclosures, I mean, that's an impossibility. What do you say to something like that? The example was given by the chair of the full committee.
Well, perhaps we should think about what we require of those companies. It's always important to look back at regulations and rules and make sure that they accomplish what you want them to accomplish. On the other hand, when you talk about small businesses and startups, there are risks there. There's a reason why if they go to a bank, the bank requires a lot more from them than they would from a much larger, well-established company that has for years disclosed audited financials and so forth. So, I'm not an expert on the different costs that are charged. There may be fees that are excessive that are charged when this happens. I'm not sure.
Okay,
well, I would look at all those.
Let me ask Mr. Barnell, you obviously have a company here that you're starting, and I hope you do have success. It certainly is a very noble cause. What about those costs we were just talking about?
So we're still a private company.
Right.
And now we do robust reporting and we do PCAOB audits, and so we have financials and all those sorts of things. But as a private company who's preparing to be public at some point, I don't have all the details, but we talk to investment bankers and others. We know that there are several $1 million of annual costs, as well as a number of hires that would need to be made within the company solely to deal with public reporting. So,
is it a barrier that you think that's insurmountable, or do you think it's a barrier that is reachable?
I think nothing's insurmountable, right? But I think it's certainly a consideration that would delay. It's a consideration that we might go public later as opposed to earlier if we take those costs into consideration.
Okay, well, let's then, talking about the private versus the public, why don't we go back to you, Ms. Thornton? I mean, you heard, again, I don't want to I hate when people put words in my mouth, but I did think I heard there's really no conflict. No, is that true? Or Ms. Pinedo, you were shaking your head. I'll give you the opportunity to.
So it's not that there's no conflict. What I said is that as a legislative and as a regulatory matter, we should be encouraging both a thriving private market and a thriving public market. Not that there's no conflict. That would be reductionist. There are reasons why some companies choose to be private and why we have private markets, and there are good and sufficient reasons why we should be encouraging companies to go public.
Okay, let me give Ms. Thornton a chance to challenge that potentially. Go ahead.
Yeah, I would say two things. One is the companies that grow extremely large in the private markets, they are doing a couple of things. They're looking at public companies to try to justify their valuations rather than providing detailed information of their financials and everything else to justify their valuation. And by the way, in a public company that discloses a lot of information is having market participants look at the company, look at the information that's disclosed, they're analyzing it. That provides a lot of support for other investors who are looking at that company to invest. But you have large, private companies that are competing with similar companies in the public markets, and that doesn't seem.
Okay, my time has expired, and I yield back, and I thank the chair.
Gentleman yields back. The chair now recognizes the gentleman from Ohio, Mr. Davidson, who is also the chair of the Subcommittee on National Security, Illicit Finance, and International Financial Institutions, for 5 minutes.
Thank the chairwoman. Thank you, our witnesses, for being here today and for your work in this field. I ask unanimous consent to submit this letter from the Accredited Investor Alliance supporting our work to expand market access.
Without objection.
America is home to less than 5% of the world's population, but we account for nearly 25% of global GDP. Even better, our capital markets account for more than 50% of the world's invested capital. And unfortunately, this abundance is not easily accessed by most Americans. Now, as investors, Americans benefit more than most countries because our retirement savings are overwhelmingly deployed and invested in our capital markets. And this isn't the case around the world. Even in Europe, it's not as common. However, when American companies want to raise capital, they often confront substantial barriers, as you all have highlighted today. One of the most basic problems is the accredited investor limitation. Essentially, unless you're already rich, it's harder to get rich. This paternalistic approach from government limits individual freedom to invest your own money, and it's supposed to protect investors. But the reality is, in practice, it protects deal flow for the donor class. For simplicity, current law equates wealth with sophistication. The problem's especially acute for entrepreneurs who need to access capital to grow their businesses, and generally businesses have no ambition to build the sort of scale that it takes to access traditional capital markets. An initial public offering, as Ms. Pinedo highlighted, costs millions and can take millions more in compliance and recurring costs. So it's entirely unsuited to small and mid-market firms, particularly those who want to remain private. And while large companies can take on debt outside of banks by accessing the bond market, small and mid-market firms generally have no such market access. So we should make it far simpler to raise equity and debt from private capital. All investors take on risk with a rational expectation of a risk-appropriate rate of return. Anyone who acknowledges those risks and knows what they are investing in should not be prevented from doing so via government-enforced restrictions. After all, the right to transact is fundamental. It's not a permission granted by government. And that's what we've turned it into, as complete contradiction of our Constitution, our Bill of Rights, recognizing that our rights are endowed by our Creator, and in limiting the government's ability to infringe upon these, we act as somehow the government's the giver of our ability to transact. So my bill for this protects accredited investors who simply say that they certify to the issuer of securities that they understand the risks of investment in private issuers. This would have the effect of providing more opportunity to all investors. So, Ms. Pinedo, could you expand on how such a change would improve capital formation?
Pinedo, yes. So I think, again, one has to go back to the fundamental purpose of the accredited investor definition, which is to allow investors that are able to fend for themselves to invest in opportunities that don't require the protections associated with registration. So that would be investors that are financially sophisticated, and we have to ascertain financial sophistication through some means.
So you still support the framework that the government could be the giver of the rights, and
No.
if we deem you sufficiently sophisticated,
No.
using some alternative legal criteria, then okay, we'll let you do it.
So that might include any of a number of the bills that are presented today for the subcommittee's consideration.
Well, I believe that'll be progress, but I don't think that you can proceed from that premise. So maybe, Mr. Conwell, when you look at your challenges, what are you seeing in the market? What's the challenge that venture firms like you are trying to do when you want to increase the ability of people that want to participate in the markets, but also the people that are trying to raise capital? What are you confronting?
Well, we're confronting a limit of sources, right? As you're raising a fund right now, if you're raising $10 million or less, you can raise from over 250 people, right? The moment you go over that, it's only 100 people. So it becomes real easy to figure out the math of what's what's the minimum amount you can take from an investment. So if I'm raising 40 million, the minimum check I can take is 250,000. So that means the amount of people I can go to raise that capital is very limited. And that means that means I have to fit in their framework for my fund to work. And that's very limiting.
Thank you so much. My time has expired, and I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Madam Chair. Mr. Barnell, I appreciated your comments because they were I sort of appreciated them. They were giving me flashbacks because I had, before coming here, had raised a couple $100 million from private equity and always felt that tension where I didn't want one more person in my office who represented my majority investor telling me what to do. I see Mr. Conwell laughing. But we hadn't quite gotten big enough to have the full reporting requirements to go public, and I'm sympathetic to that tension. I also think that every debate we have on this committee is fundamentally about the tension between capital market access and investor protection. Push more in one direction, you go the wrong way on the other, and I think that's healthy to talk through it. But I want to try to highlight that, Mr. Conwell. How much did you say you're currently managing in your current fund?
Currently is 9.3 million.
Okay, and is that your first fund?
First fund, yes.
And how many LPs do you have in there?
194.
Okay, and when you make an investment in one of your target companies, do they all have to sign off on the investment, or you've got a deal arrangement with them that they've agreed to be in the fund and then they trust you to make those investment decisions?
It's an agreement where they fully trust me to make the investments in the fund, and they are given all the documentation up front
Sure.
to let them know how I invest and what I
Yeah,
do.
which is fine, and that was my experience. But my point is that none of those investors essentially get any disclosure other than when you come back to raise your next fund, you're going to have to describe your fund performance. But you are not providing those investors with disclosure, as you shouldn't, because
No, I do provide them with disclosures.
compare, if I was doing a public listing, I would have to provide 3 years of audited financials, I'd have to provide details on my management team, I'd have to do all that stuff.
I give them all
your LPs do not, let me move on.
No,
Your LPs don't have to go through to that disclosure, which is fine. I'm just flagging that there's a question of where the protections are for the LPs as accredited investors, because we trust they have this and they don't. Ms. Pinedo, there's been a lot of talk by my colleagues across the aisle, which is just wrong, so I'm hoping you can correct it. Can you talk about the trend line in total capital available for investments, public and private, over the last couple of years, rising or falling?
So in my testimony, I have data regarding the amount of capital that has been raised in public offerings, which has declined by comparison to the amount that has been raised.
Yeah, but
Sorry.
the total available has
The total
surged,
available
right?
has surged.
And broadly speaking, that's been because private equity has really surged and taken off.
Absolutely.
So the idea that there's a shift, and just on that point, do you know what the total market cap is of all private equity funds versus the total market cap of public trading companies?
It vastly is, yes.
Yeah, it's like 56 trillion of private,
Yes.
of market cap in public funds versus
Absolutely.
3.5.
Yes, private equity
So-
and private credit in recent years
Yeah.
as well.
So essentially, the surge of private equity has created pockets of capital that early stage companies that are worth less can access, thanks to people like Mr. Conwell.
Yes.
And we still have public markets on the back end for exits, which is where the huge value creation is. And so the
That's right.
story that people are fleeing public markets is really a story about there's been a huge surge in alternative types of capital that are available.
Yes.
That people like my company, Mr. Barnell, you wouldn't have had, you couldn't have gone public when you were 2 kids out of college. Nobody would have given you money. You found people to give you money. That's awesome, right? Thanks to people like Mr. Conwell. Let's celebrate what that is. But back to my initial question, I have never met a CEO, myself included, who does not want dumber money. Right? Dumb money is awesome. If you don't have accountability, you can do what you want, it's fantastic. And so, Ms. Thornton, should we be concerned that the Trump administration is laying off tons of people at the SEC, including all of the directors who were responsible for making sure that there were appropriate disclosures of Mr. Musk's purchase of Twitter?
Yeah,
That seems like working backwards on investor protection, right?
absolutely.
Should we be concerned that all of my Republican colleagues are trying to say that if you tokenize a security, you should not even have to be regulated by the SEC, which is the disclosure-based organization. you should just all of a sudden you're a commodity magically.
We should be very, very concerned about that because people have an expectation of profit when they invest. There are people who are new to this type of investing and they could lose a lot and they could, you know, when Sam Bankman-Fried did his thing.
Yeah, and
we
I'm
saw
sorry
a
to cut
lot
you
of
off because I got 15
Yeah, yeah.
seconds. I just want to give you.
Yep.
Are there any proposals before the committee today that would increase investor protection?
I don't recall seeing any when I did my initial review of the 36
That's
bills.
exactly my point. There's a healthy tension. There's an effort going on in the Trump White House to fleece the investment public.
Gentleman's
I
time
welcome the
has expired.
tension, but let's not deny what's going on here.
Gentleman's time's expired. The chair recognizes the gentleman from Indiana, Mr. Sussman, for 5 minutes.
Thank you, Madam Chair, and I ask for unanimous consent to submit for the record a letter from the American Securities Association regarding the hearing today, and would...
Without objection.
Thank you. First of all, thank you to all of you. This has been a fascinating hearing. I was absent from Congress for the last 8 years and was an entrepreneur and looking to raise capital to start companies or to revitalize companies or to grow companies. And so, Mr. Conwell, your story is fascinating. Congratulations on one hand, but I know you've got probably some scars to show how you got to where you are, as well as Mr. Barnell as well. And but I'd like to ask a little bit about, and I appreciate the gentleman's comments. And you know, we are really in that balance between access to capital, but in protecting investors. And I've been in many meetings, you trying to explain the project and say, this is why, you know, we believe it's going to be successful, and you know, we would love your participation and investment as well. And it really, it's, as he mentioned, there's dumb money out there. That's unfortunate, but you know, we also, people are wanting to participate because they're working on in their daily job, they're raising their family, but they're also feeling like, I have a little bit of money here, I'd like to participate somewhere. How can I do that? What's the easiest way to do that? And I guess a question for Mr. Conwell, could you touch on maybe crowdfunding just a little bit and how that's playing in today's fundraising and capital formation?
If you wouldn't mind, I'd like to see that question, Ms. Rebecca. She does with crowdfunding.
Okay.
She's the expert here.
All right, that's fine with me.
Could you repeat the question?
Well, just can you talk a little bit about crowdfunding? I mean, it's been around for a little while, but with technology and easier access, and could you talk a little bit about where crowdfunding is playing in capital formation in today's markets and fundraising?
Yes, it's incredibly important, the technology that we've built at Dealmaker and that a lot of our colleagues have built in the space is foundational to helping more entrepreneurs get funded. In today's day and age, we can do that, especially for jurisdictions that aren't Silicon Valley or Wall Street, by getting deals like Mr. Andrew Barnell's in front of people in all different regions. And so we can draw from the communities and we can help form businesses that aren't based in those city centers.
And what about investor protection through that avenue? What are some of your thoughts on that? Is there enough protection? Is there enough information disclosed?
The legislation is incredibly well designed. We have the Form C, we have the 1A. What we've actually seen is that with that standardized disclosure, more junior investors can become more sophisticated because every deal they look at, there's the same format where they can read the same information. And it's actually desirable that the whole exempt markets move in that direction.
Yeah, okay. Mr. Barnell, I mean, congratulations on your success, and I know that as an entrepreneur, you're always looking forward. Sometimes it's good for us to always just take a glance back and look at how far we've come, but there's always more work to do. Could you talk a little bit, you mentioned in your remarks about the difficulty raising funds in the Midwest. I guess I'm just curious, because I come from Indiana, and I would agree with that comment, but I'm kind of curious of your experience and why you mentioned that in particular, and do you have any ideas what could be done to change that?
Yeah, absolutely. There's one stat I always like to cite. It's not that there's an absence of industry or capital to deploy, right? I think sometimes it's the infrastructure doesn't exist. So if you look at the data, 20% of the GDP in the country, 20% of the jobs are in the Midwest, but only 4% of the venture capital is deployed there.
Yeah.
So it's not an absence of the capital, it's an absence of the means to make it happen, which is why I think things such as making it easier for venture funds to form because we have fewer venture funds per capita than other places, easier to crowdfund. Those are the ways we solve the solution and make it easier and provide the knowledge for people to invest in companies when they want to and when they see the opportunity.
Is it just a matter of connecting those who have funds to those who have projects? Because I know that, in the Midwest, Congressman Style and my district are some of the heaviest manufacturing districts in the country. And a lot of these folks, maybe they came off the farm, they know how to build a widget, but they don't necessarily know how to finance something. Is that something, is there places out there that we try to connect people to be able to fund projects like that?
And I don't know all the solutions, but I can speak to some of our experience. We're a colorectal cancer screening test, and early on we had a lot of doctors and gastroenterologists say, I want to invest in this. I've never done it. How do I do it? Is this like buying a stock, right? And so I think it's the education, it's the funds. I think there's a lot of things that we need to do to make it happen. But I think if you move that direction over time, you're going to be in a much better place from a capital formation perspective.
Thank you, Madam Chair.
Gentleman's time's expired. The chair now recognizes the gentleman from Wisconsin, Mr. Stile, who is also the chair of the Subcommittee on Digital Assets, Financial Technology, and Artificial Intelligence, for 5 minutes.
Thank you very much, Madam Chair. Thanks for holding today's hearing. I'd like to start with you, if I can, Ms. Pinedo. Emerging growth companies, how do we get companies onboarded, navigating through the capital raise, in particular in early formation? As we look at the number of companies that are choosing to go public, we continue to see that decrease. Emerging growth companies and the regulatory environment in that space is trying to lighten that burden to encourage early stage companies to move forward, to access the public markets, and to use the public markets as a vehicle for growth. I know you're familiar broadly with this space. We'd love you to comment on it, but in particular, what types of industries are uniquely utilizing this? Mr. Stutzman correctly noted both of our districts have a history of capital-intensive manufacturing, but there's also a lot of tech companies, whether or not it's biotech or other areas. And what type of industries or companies might be uniquely interested in emerging growth companies?
So almost all of the companies that have gone public since the Jobs Act was adopted have qualified as EGCs, as emerging growth companies, and the Jobs Act has been a resounding success. So I take issue with the subcommittee member who said that the bills under consideration today would eviscerate investor protection. That's simply not true. The framework for disclosures by EGCs is robust. There are some disclosure accommodations that are made for EGCs, but there are strong investor protections. And
are there certain industries that are uniquely inclined to look to the emerging growth company?
It's a wide array of industries that have utilized the IPO on-ramp, and that includes tech companies, life sciences companies, industrials, consumer products companies. So it's a very broad representation, and it's been very dependent on the market and what the market is receptive to.
Should Congress extend the IPO on-ramp, the ECC threshold?
Without question, it has been a success. It will continue to be a success, and it will continue to attract companies.
I appreciate you saying that. I have legislation that would do just that.
Yes.
Final comment on this. Is there stuff that are there rules, regulations, adjustments that should be made at the SEC without acts of Congress as it relates to emerging growth companies?
So the acting chair referenced in his speech that the SEC intends to look at right-sizing regulation and looking at the disclosure accommodations for different sized companies, smaller reporting companies and other companies, and looking at the disclosure burdens that are applicable to different companies. Among the bills under consideration today are looking at the definition of smaller reporting company, accelerated filer, large accelerated filer. All of those things are appropriate measures and good things for capital formation.
Thank you very much. I just want to be cognizant of the time because I want to come back over to Mr. Conwell and Mr. Barnell in particular. As Mr. Stutzman referenced, I'm from Wisconsin, he's from Indiana, manufacturing base. but a long way from Silicon Valley, New York City, or other traditional VC hubs. In your testimony, Mr. Conwell, you referenced some of the challenges you face in obtaining capital. Mr. Barnell, you've talked about this as well. Are there specific policy changes or adjustments that you would like to see? I'll start with you, Mr. Conwell, and I'll come to you, Mr. Barnell.
For me, I am very focused on this limited partner limit on in funds. Currently, it's 100, which including yourself makes it 99. In the Jobs Act, when they increased the limit for funds that were 10 million or less to have up to 250, that's what allowed me to raise my fund. If not for that, this doesn't happen. In the 47 companies I invested in, probably more than half of them don't exist, right? Now that I'm going to higher than a $10 million limit, those individuals are I can no longer raise from them. And if they feel like I've done a good job, they can no longer participate with me.
Thank you very much. 15 seconds, Mr. Barnell. Anything jump to mind?
Just very briefly, I mean, for us, it really was investors like to invest local, right? Especially at early stage, and facilitating that, I think.
So the answer is everyone should move to Wisconsin, and as a backup plan, Indiana. Thank you very much. Appreciate you being here. Madam Chair, I yield back.
And don't leave St. Louis, Missouri out, Mr. Stile, all right. Gentleman yields back, and the chair now recognizes the gentleman from New York, by the way, Mr. Lawler, for 5 minutes.
Thank you, Madam Chair. I have a letter to submit without objection to the, on behalf of the Innovation Coalition.
Without objection, so ordered.
Thank you. It is ingenuity and the generations of entrepreneurs and innovators utilizing emerging technologies that have built America and will be crucial looking forward. Entrepreneurs and small businesses drive the American economy. In 2019, the Small Business Administration calculated that close to 44% of our GDP was a result of small businesses. We should be doing everything we can to promote investment, promote entrepreneurship, and foster small business growth, whether it be cutting red tape, providing additional access to capital, or simply getting government out of the way. And that's why I introduced the Helping Angels Lead Our Startups Act, otherwise known as the HALOS Act, to promote access to investment capital for small companies and ensure that startups can continue to generate interest and connect with investors. This would ensure that demo days, pitch competitions, and community economic development events where there is no specific investment offering are not considered general solicitation under Reg D. The HALOS Act, which is noticed with this hearing, is one of a number of common sense legislative reforms we should be taking to ensure that startups and businesses have the resources they need to develop, to grow, and thrive. The Jobs Act directed the creation of regulation crowdfunding to build on crowdfunding as a new and innovative way for startups and small businesses to raise capital, typically over the internet. The number and size of regulation crowdfunding offerings has continued to increase over time. Noticed with this hearing is proposed legislation from my colleagues, including a rep measure that seeks to build on that success. Ms. Kacaba, I know you touched on this briefly about the benefits, but how would enhancements to regulation crowdfunding help small businesses raise capital? Would it be beneficial to expand the number and range of investors that can participate in crowdfunding offerings? And are there additional enhancements that you believe we should make to improve the utility of it?
Yes, absolutely, and thank you for the question. I agree with what you said. The Jobs Act, since its inception, has helped so many small businesses form and so many jobs be created. There are very simple, small adjustments that we can make so that the online crowdfunding space can flourish to allow more growth and more jobs to get funded. And those are in our written statement that we advocate for. The HALOS Act is an incredible step in that direction.
Appreciate it. Any of you care to comment as well? No? Okay. I think from the standpoint of additional enhancements, Ms. Kacaba, what would you say are the necessary steps?
I think it's important to remember that non-accredited investors are looking to build wealth. And studies show that younger generations don't believe they're going to build their wealth from their direct jobs. They're looking for other ways in the gig economy, and they're looking to make investments. And so if you regulate them out of a space where we're doing bad actor checks, we're doing background checks, we're doing disclosure documents, you're just forcing them to put their money into other sectors like crypto, like NFTs, like the public markets, and there are no caps in those spaces. Under the Jobs Act, there's a cap in how much they can invest in every single offering. And so the Jobs Act is well designed that way. If we remove the cap on Reg A, we can grow the space, we can grow online offerings, and we can grow the ecosystem and communities of people that want to invest in businesses they love. We have a customer monogram. It was started by 2 doctors. They saw the need for a robotic knee replacement surgery arm. VC wasn't interested in funding that business, but there's a lot of people out there that know someone that's had knee surgery that thought that was a really interesting business. Now that company is public on NASDAQ. So if we can grow the online capital formation space by increasing the caps and streamlining the way Reg A and Reg CF work together, we can get more businesses funded.
Appreciate it. And with that, I yield back.
Gentleman yields back. The chair now recognizes the gentlelady from Michigan, Ms. McLean, for 5 minutes.
Thank you, Madam Chair. Before I get started, I'd like to enter in for the record a letter from Engine, which is a nonprofit group advocating for tech startups.
Without objection.
Thank you. I'm going to piggyback a little bit off my colleague from New York, Mr. Lawler, and what we've been talking about. I love economic growth. It is the backbone of our great country in which we live in, and we must remember that it is our economic system that gives us our social programs. And I find it sometimes ironic that some members across the aisle from us are for growth. They're just not for public growth. They're only for public growth. They're not for growth in the private sector. And we have got to do more to incentivize growth in the private sector, right? Not just the government, but private sector's good. Entrepreneurship is good. That's what this country was built upon. So I'm here to advocate for more private sector growth that all Americans can participate in. I have a little bit of experience. I had a business for 35 years in the financial planning sector. And just out of curiosity, you know, with all of the departments that I had, anyone want to guess where I had the most resources in terms of people and money? What department maybe that was? I think it was maybe the processing. We did about $13 billion, you know, maybe the processing sector.
Legal and compliance.
Compliance, spot on. Every year, right? Now, I do agree regulation is needed. I would say guardrails are needed, right? But at some point in time, we have to let the businesses run, right? We have to have a little bit of faith in people. And over-regulations do more harm than good on the consumer because we want competition. Competition is good, right? It lowers the prices. In order to achieve this economic growth and development, though, we need a strong and healthy capital formation. We have to get this ideologically. If we're not allowed to invest in our future, my company would never have been able to survive. We have to reinvest, and it's critical. Ms. Pinedo, excuse me, what are some of the most burdensome regulations that prohibit capital formation, in your opinion?
So it's not so much that they prohibit capital formation as that they make being public less appealing than in past times, and a lot of that is related to Sarbanes-Oxley 404 attestations. So that's certainly something, and one of the bills under consideration, which addresses SOX attestation for low revenue issuers, would be very helpful. Another would be looking at the disclosure burdens and the standards for disclosures as it relates to different types of companies or companies of different sizes, so that disclosures are more right-sized, if you will. And that would address whether companies that are smaller reporting companies or accelerated reporters and so on could address the disclosure burdens depending on their size. So that would be another issue. Likewise, a different but related issue that is not under consideration but probably ought to be is bringing back some of the ecosystem that once existed for companies that are public, and that would be addressing the regulation of research and addressing the regulations and the rules related to offering related communications. So I mentioned that our smaller public companies and our medium-sized public companies no longer benefit from being public. A large part of that is because of the lack of research and the lack of liquidity in their stocks.
And I think we would all agree that we have to do more to incentivize as opposed to disincentivize. In my last few seconds, what can we do, in your opinion, to ease some of the compliance and disincentives? What could we do immediately, in your opinion?
So extending some of the Jobs Act benefits, which these bills do, would be a great start.
Thank you. And with that, Madam Chair, my time has expired. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from Montana, Mr. Downing, for 5 minutes.
Thank you, Madam Chair. First of all, I have a letter from CARTA that I would like to submit for the record.
Objection.
Thank you, Madam Chair. I'm really excited about the work we're doing on this committee. My previous job, I was the Securities Commissioner for the state of Montana. One of our charges was capital formation. It was always an interesting project because we have so much talent, so many entrepreneurs, and we also have money trying to find investments and figuring out how to, put the two together and do it, within, the regulatory framework. It was exciting work, but obviously had its challenges. Mr. Conwell, according to the Small Business Administration, 99.3% of businesses in Montana are classified as small businesses and employ about 67% of Montanans. In being a rural state, and talking about the challenges that I had as a regulator, can you explain the challenges for rural small businesses to find potential investors when they're located in places that lack any kind of capital raising networks?
That is a compounding issue. It's one of, if you're in a community like that, there's going to be less funded companies already, so there's less information, there's less people you can go to learn from. So when you're getting started, you start off just kind of fumbling off in the dark, running into walls, trying to figure out where to go, what's an investor. Once you figure that out, then you start going in your community like, well, where are they? And then you realize at some point, I got to go to New York or California, and that's what it is. That is, we see time and time again. And even though we talk about the coast, I'm from Baltimore. My founders leave and go to New York all day, every day, right? So it's something that we see in all of these communities, and a lot of it is because, well, some of it is because the information's not as widely out there of like, these are other ways you can get capital, and people sharing that in their communities. Need more demo days, those accelerators, all that. But then also incentivizing the folks there locally to participate, really the angel investors at the early stages, getting people started. Having those individuals in your local community who know you, who believe in you, who have seen you grow, who have affinity with you, being able to put money behind you, but with an incentive, tax credit, something like that, something to make people start thinking about, oh, like this is a viable thing. I believe something like that will start to buoy communities and rural communities, and we've seen something like that in Maryland. We have a Economic Development Corporation, a TEDCO, that does outreach into our rural areas specifically to do things like this.
Right. Moving on, I've struggled in a previous life raising money basically under Reg D exemptions, alternative investments, and with the accredited investor, criteria. And it's always, it bugged me when I was on that side of it because it didn't seem to really correlate to your ability to make a decision on taking risk. You know, I would think if you were somebody inexperienced and uneducated who had a windfall, maybe you inherited some money, you're an accredited investor, but you could be a PhD in economics and finance with $100,000 and you can't invest that. So it really limits, folks that can participate in these. So I'm going to go to Ms. Kacaba. The current accredited investor standard limits in the private market, limits investments in the private markets to individuals with an annual income of at least $200,000 or a net worth of over $1 million. And the median income in Montana is nearly $71,000, with only 8% of households making $200,000 or more. We've discussed throughout this hearing that the overly restrictive accredited investor definition denies small businesses access to a large pool of investors. And it's no surprise that the investors that typically meet this standard live in urban areas. And I'm coming from a very rural district. Do you believe rural investors can be just as sophisticated as urban investors and should be allowed to more freely participate in private markets?
Absolutely, yes, and thank you for the question. I think that's a really important point. They are looking to generate wealth creation. The rules that we have in front of us already prevent them from investing too much in any one offering. So the rules are properly structured for them already, and we need to realize that if we don't let them into the private markets, their money is going to go elsewhere. And the private markets are well regulated, so they should be allowed to participate.
Thank you. Can you maybe elaborate on or discuss how the current accredited investor standard unfairly denies rural investors growth in their retirement accounts like a normal hardworking Montanan?
Yes, because they're limited in the offerings that they can get access to. Even some of the changes that we've advocated for, removing common control, would allow them access to investment in VC companies. For example, there might be a VC with a portfolio of 10 companies and they want to do follow-on investment in one. 9 of those companies are excellent companies. They don't hit a 50% growth rate that a VC requires for follow-on investment, but maybe they're doing 35%, and lots of people in Montana could invest in that and make a good bit of money.
Awesome. Well, thank you. I've run out of time, but thank you for your responses.
Gentleman yields back. The chair now recognizes the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Chairwoman. Thank you very much for holding this hearing today. Before I start my questions, I would like to offer this letter from Scroobius, which talks about a virtual platform designed to connect early-stage founders, investors, and partners. For the record.
Yes, ordered.
Thank you. Thank you, Chairwoman. Business development companies, or BDCs, are an important source of capital to Main Street businesses, having a statutory mandate to invest in U.S.-based small and mid-sized companies. However, the SEC has applied a rule known as the acquired fund fees and expenses to BDCs that presents a misleading picture of the true cost of investing in a BDC. Because of this, BDCs were excluded from certain indexes, causing an outflow of institutional investor dollars in BDCs. I'm saying BDCs a lot. I've put forward a bill recently that would fully exclude BDCs from the AFFE requirement to fix this problem. Ms. Pinedo, can you explain how the SEC's posture on AFFE has impacted BDCs, their investors, and portfolio companies?
Sure. So just as you said, BDCs are filling an important gap. BDCs provide venture debt and other funds that banks are not providing to smaller and medium-sized businesses. When the SEC changed its policy in 2006 to require the presentation of AFFE, it now requires the presentation in the fee table of an artificial and kind of inflated percentage of fees over a period of time, over a 1, 3, 5, and 10-year horizon. And as you indicated, when that change became applicable, it triggered BDCs from falling out of a number of indices. Because so many institutional funds are index trackers, it meant that institutional investors moved out of investing in BDCs. That meant that BDCs lost a tremendous amount of investor interest, in particular institutional investor interest. And we should be promoting investor interest in BDCs, again, because BDCs provide capital to Main Street and provide capital and fill this gap that is no longer being served by banks. We should also be considering other important steps to modernize the regulation of BDCs. So I wholeheartedly support reversing the AFFE policy, and in my written testimony provide a number of suggestions for modernizing the regulatory framework relating to BDCs.
Will the gentleman yield?
I got to get through this, I'm sorry, thank you. So in your view, exempting BDCs from the AFFE requirement would result in more accurate disclosures?
Yes, it would.
Okay, great. Alternative investments, which can include private credit, real estate, infrastructure, have shown value in recent memory. These vehicles help balance investment portfolios, spur job growth, facilitate capital formation, help provide more uniform investment returns for individuals. What role do you see, Ms. Pinedo, in the alternative investments playing in capital formation?
So alternative investments, including BDCs, interval funds, tender offer funds, target date funds, all of these different funds can provide an important role in capital formation in terms of supporting investments in other private funds and investing in the securities, in securities of private companies. And again, we should be looking at ways to enhance and promote retail investment opportunities in private funds and in modernizing the regulation of these regulated funds, as well as in looking at ways in which we can further extend the reach of a lot of these regulated funds so that they can provide, so that they can offer fund interest, not just to qualified clients, but also to a broader range of investors.
Thank you. And you talked about regulatory modernization in your answer before about BDCs. Do you think, would you agree that regulatory modernization is necessary to provide greater options to qualified and accredited investors as well?
I do. I do think that that's absolutely necessary. And I think we've talked a little bit about potential changes to the definition of accredited investor during this, during today's hearing. Many of the measures I do support. In the context of BDCs in particular, the AFFE change is important. I think many of the changes that much of the relief that the Securities and Exchange Commission provided for BDCs during the pandemic, which did not sacrifice investor protection, should be extended and was important. And again, to the extent that BDCs are significant for capital formation, it would be helpful
Gentleman's
to
time's
extend
expired.
it.
Thank you.
Madam Chair, I ask unanimous consent to put into the record a letter from the North American Securities Administrators Association.
Without objection, so ordered.
I'd also like to add to the record that the BDC bill is one that I introduced in the 116th, 117th, and 118th Congress, and look forward to introducing that.
I love it when we can play well together, both across both aisles. Lovely, lovely. And I believe our last person to come forward with questions, our member is gentleman from Tennessee, Mr. Ogles. You're recognized for 5 minutes, sir.
Thank you, Madam Chair, and thank you to the witnesses. I know sitting here through the hearing is arduous, but we appreciate you being here because the information you provide is valuable to us, but also the American people. Mr. Barnell and Mr. Conwell, would you agree that over-regulation is a major barrier to entrepreneurial capital formation for American investors?
Yes.
Yes. So I want to put a pin in that for a moment. So as we see the current Trump administration aggressively moving to try to right-size government, as we see the DOGE initiative under Elon Musk looking for areas of waste, there's only so much the American government, the U.S. government can do to cut waste and spending. We've got to do our jobs, and that's tough. But the future of our economy, the future of combating the $37 trillion in debt and growing, is the American economy. So as we look at capital formation, the purpose of this committee, I want to ask the question, is as we look to the future, capital formation, entrepreneurism, the future of saving the republic, what role does the regulatory regime play in hindering that growth, that entrepreneurism, and quite frankly, our future? I'll start with you, Mr. Barnell.
So what I'll highlight, and I wholeheartedly agree that I think the foundation of our economy, job creation, innovation, it's all driven by startups. I think one of the things that I highlighted in my written testimony is ultimately we do see as we continue to grow the requirement, potentially ultimately to access the public markets. And one thing I highlighted a little bit earlier was that the disclosure requirements, the regulatory requirements that go along with that, it's a challenge. It's a real challenge from a cost perspective as well as from a compliance perspective. So that would be one thing that I would highlight that as we continue to grow would certainly be something that we wouldn't want to hinder our ability to continue to save lives through innovative technology and also drive job growth.
And Madam Chair, you know, we saw in the last administration the weaponization of the government, whether it's the Justice Department or the regulatory agencies, against the American people, against industry, against businesses. And again, I just want to emphasize this role of getting regulation out of the way of the economy, getting regulation out of the way of those who want to start the next whatever, right? The next Tesla, the next Facebook, the next whatever's over the horizon that we can't see and anticipate yet may very well be hindered by this regulatory regime that was put in place that is literally targeting the consumer by getting in the way of business. Mr. Conwell.
As I mentioned in my testimony, when I raised my fund, I raised $10 million, but I had been oversubscribed. I had gotten north of $30 million worth of interest. I turned away more than 200 investors who wanted to invest in my fund due to the limits. And I invested in 47 companies. Had I raised $30 million, I'd have invested in over 100. And because I'm one of the earliest investors, I'm typically the first investor in many of the companies. Like a company out of Memphis, Tennessee, Blank Beauty. It was a little company making this cool robot that would make custom nail polish. Their first customer was Walmart. Now, and what they did is they created a vending machine that will make you a custom nail polish. Well, Walmart also has this issue of people stealing things, and so they're putting stuff behind glass. They're looking to replace that glass with this really cool, fun, innovative robot that is increasing sales and getting more people in the door from a little company out of Memphis, Tennessee that nobody had ever heard of or seen, and I was the one to seed them to make sure that this could be a thing. Right.
Well, as someone who's a congressman from Tennessee, we thank you investing in our economy and the job growth, et cetera. I'm running low on time, so I'll catch the next two ladies really quickly. Ms. Kacaba.
Yes.
Go ahead.
Yes, I think the points you're raising are incredibly important. There are so many companies, like Mr. Cromwell highlighted, that dealmaker backs and funds in rural jurisdictions. And the written submission that we've submitted is just to get some of the regulations out of the way so that we can do more. And if there are different nuances made, if the caps are improved, if 5110 is removed, there are different ways that we can get more entrepreneurs funded, more jobs created.
Madam Chairman, imagine that. Less government is better. Ms. Pinedo, the last word.
For other reasons we discussed today, I support the bills that have been introduced.
Madam Chair, we thank you for your time, your leadership, and I yield back.
Gentleman yields back. And last but not least, just under the wire, the gentleman from Massachusetts, Mr. Lynch, is recognized for 5 minutes.
Thank you, Madam Chair. I appreciate it. As Mr. Barnell mentioned in his opening statement, he talked about the fact that 90% of startups fail. And so as Congress sees it, we question, should we allow more people to get into that, to invest in something where 90% fails? Should we allow small pension funds or individuals who might be investing their life savings or their retirement in an area where we're going to see 90% failure. And that's what troubles us. We do want to energize and finance startups, because as the ranking member has said, I mean, you know, all you need is that 10% that succeeds and you can change the world, right? So we're trying to manage this balance. So Ms. Thornton, are we doing that properly now? Are we protecting small investors? Would an expansion of you know, accredited investor and opening up to a wider group be in the best interest overall of American investors?
I think your concerns are well placed about expanding who can invest in the private markets because of a couple of things. First of all, there's no mandated disclosure in private markets, so even if you were a sophisticated investor, you wouldn't know that much about these companies. But in addition, in the public markets, information is disclosed publicly, a lot of information, and market participants analyze it, and there are all kinds of other market participants that help investors understand that company. But the other big thing that I would be very concerned about is just that if you expand it beyond the current people who invest in the private markets, you could be talking about people who have investment savings that they're planning on using for retirement. You could have pensions that have their rules replaced with, you know, allowing them to invest more in alternative investments. And you could really see, these are very highly risky markets, and you could really see harm to people's retirement savings. It could be truly harmful to them.
Yeah, and the other thing I worry about is as you've mentioned, is pension funds. So I think 67% of investments in private equity come from pension funds. And so it's the same thing with hedge fund investors. I think somewhat less, but maybe 30% of the inflow on hedge funds is coming from pension funds as well. We've seen some situations where in recent collapses, I think it was I think it might have been Silicon Valley Bank, where, you know, CalPERS, the California pension fund, was significantly invested in that, and it went south. So the level of transparency that we would like to see and availability of that information to the public is just not there. It's just not there at all. So are there steps that we could take to rebalance this in a way that does not choke off you know, meaningful investment to startups and other high risk but worthy investments, and yet give people an opportunity to, over the long term, earn sufficient you know, interest on their you know, pension fund savings?
I really think that the main thing is to get the big companies out of the private markets, to force them to comply with the public disclosure framework. So there will then be more diversity in the public markets, by the way, and then the private markets will be better equipped for what they are appropriate for, which is small companies, small businesses and startups that need long-term capital that's quiet, that is not worried so much about losing all their money.
So what was your position on the private fund advisor rule that the SEC had proposed?
I thought that was a very well-done rule. I thought it was really important because right now, investors aren't getting good advice. They can't be sure that they are, let's put it that way. I thought there was they may be paying higher fees, they may be paying hidden fees that they aren't aware of.
Okay. Madam Chair, thank you for your courtesy, and I yield back.
Gentleman yields back, and I just want to thank all of our witnesses for their testimony today. We certainly had very robust participation by our members, which is, I'm always glad and heartened to see. Without objection, all members will have 5 legislative days to submit additional written questions for the witnesses to the chair. The questions will be forwarded to the witnesses for his or her response. Witnesses, please respond no later than March 31st, 2025. This hearing stands adjourned.